Hello students, welcome to the lecture on financial business decisions and leverages. And after this lecture, we will be able to learn the following objectives. Define the analyzing financial business decisions, explain the cost volume profit analysis, understand the break-even analysis, and explain the exploring the concept of leverage in finance. Analyzing financial business decisions. Let us start with how the finance department works. The finance department of a company generates a variety of financial information that is helpful in decision making, including profit and loss accounts, providing details of whether the business is making efficient use of financial resources. By providing a steady and up-to-date flow of information, a business is able to make appropriate decisions about how to reduce costs, how to increase sales, how to raise profitability, when to purchase new capital assets, the best sources of finance and duration, etc. Accounting is the business function of recording, reporting, and analyzing financial information. Several types of accounting tools are available for business owners to analyze and assess the strength of their company's operations. Financial statements. The most common accounting tool used for business decisions are financial statements. These statements usually include the income statement, balance sheet, and statement of cash flows. Financial ratios. Financial ratios are a more in-depth analysis of the company's financial statements. These ratios take specific pieces of information from the financial statements and use mathematical formulas to create numerical indicators. Forecasting. Forecasting is an internal or external analysis method used to determine the potential production output or sales of the company's products.
Well, hello Internet, and welcome to my financial statements tutorial in which I will explain exactly how all the financial statements work that are used within a business. And I'm going to use a real-world example in this tutorial. I'm going to fill in step by step the financial statements and explain what all the jargon means through the use of a fake caricature drawing business. This tutorial came together because I received this request from Anne, and she did not want me to give her last name. First off, I'm going to go over the balance sheet. The balance sheet describes a business's financial situation at a moment in time. The left side details the assets a business has, and the right side details how those assets were acquired. At all times, both sides must remain equal. And you can see in the lower right hand corner, a very simple way to start a business is with cash and an original investment by me, the owner. Of course, most businesses start off with a loan, and your rich uncle decides to give you $100 and he expects 10% interest to be paid on that $100 loan sometime within a year's time. A long-term loan that includes interest is known as a notes payable. And you can see in the lower right hand corner here, now I have an original investment plus the loan from my uncle, also known as a notes payable. And when you add those two things up, you get my cash amount, which is $200. Now there are two different types of owners of a business. There are people the business owes money to, or liabilities. See, I changed the right side to the word liabilities. And then there's the part of the business the owner owns. This is known as owner's equity. And you can see here original investment lies under owner's equity, and everything else still equals out. And also you're going to learn the most important equation in whenever it comes to balance sheets, and that is that assets always will be equal to liabilities plus owner's equity. Inventory is what you sell. When you buy inventory, you decrease the value of cash. You do not decrease anything else or change anything else. So whenever you purchase $50 of inventory, you're going to get, for your caricature drawing business, 50 sheets of paper, which cost a total of $35, and then you're going to get $15 worth of markers and colored pencils. And this inventory is going to allow you to create exactly 50 caricatures in my sample business. Now let's say you go to a party later on that night and you draw 40 caricatures for $2 a piece. That is $80 in total sales. Well, that would mean that your unit cost is equal to the price of inventory to create one finished good. So if you have $50 in inventory and that inventory creates 50 caricatures, that means your unit cost is $1. Now, cost of goods sold is going to equal out to $40. And what that means, just quite simply, is you sold 40 caricatures, as I detailed above, at a unit cost of $1 each. So it cost you $40 to create the goods that you then sold for $80. You would then subtract the cost of goods sold from your total sales of $80 to find your gross profit. And gross profit is just simply, as I have here, sales minus cost of the goods that you sold, and net profit, as you're going to find out later, is gross profit minus any additional expenses. So let's look at this more closely. We started off with $200 in cash, which came from our original investment and the notes payable from our uncle. We bought $50 worth of inventory, and then we made a total number of sales of $80. That's how we get the cash amount here of $230. Well, you can see down here I have earnings week ending. This is another part of the balance sheet I'm introducing here for the first time. How I was able to calculate this is to take the total number of sales minus the cost of goods sold, which is $40, to get a final earnings week ending of $40. And if you add both of these sides up, you come to the same number, being $240. You've decided it's time to expand. You've decided to increase the price of your caricatures to $5 each, to rent a space at the mall for $80 per day, and to buy a sign and an easel for a total of $50. You then go on to buy $50 in raw material inventory. Raw material inventory is inventory that is not prepared to sell. It will become a finished good, as you're going to see here in a minute, right after you're done making the drawing. Well, let's say that your first day at the mall, you make $300 in total sales by selling 60 caricatures. That's 60 times $5, as we have up here at the top. And you're also going to see here a new piece of the balance sheet being retained earnings of $40. That was from the $40 that you made during your first day as a caricature artist. And you see here your additional sales of $110. And on the next slide, I'm going to go through exactly how that was calculated. You can see here, what I did was I took my previous cash amount of $230, subtracted out the $130 that I used to buy the easel and all the other additional things, subtract out the cost of my inventory, and then added my total sales to get $350. And I was able to calculate earnings week ending, which is over here, by taking my total expenses out and my total cost of goods sold and adding in my total sales to reach an amount of $110. And then if you add all of these things up, you come to $350. Most errors in accounting are caused because of a lack of understanding on how to calculate earnings week to date. And another financial statement, the income statement, helps you to avoid making that mistake. An income statement is normally updated on a weekly basis, while balance sheets can sometimes go for months without being updated. So what I did here was I took my first day at the mall and I put my sales in the upper right hand corner, and this is the basics of what an income statement looks like. Then I take my beginning inventory, because remember on my first day I had $50 of inventory to sell and I only sold 40 caricatures, so that's what this is. Then I went out and bought additional $50 worth of paper and markers, put that there. Then I add all these up and put the total amount of inventory that's available to sell, and then the amount of inventory left over after my first day at the mall, which was $0. That gets me my total costs of goods sold, which is $60. I subtract that from the sales amount. I then subtract out my rent, my sign, my easel, my total expenses, and that's where I came up with the number 110. If you look over here, that's what you got, earnings week ending. So this is the reason why you use an income statement. It allows you to keep everything straight. Because let's say I didn't sell all of my inventory. Well, and this is a common error, let's say I only sold $50 of my total inventory. Well, I would only subtract $50 from this $300 and leave the additional $10 here in ending inventory. That would keep everything straight. You do not subtract out all of your inventory from your sales to reach your earnings week ending. You instead only subtract out the cost for the inventory that you sold. And I'm going to do a ton more examples. Believe me, this is going to become completely understandable. Your second week in business, you decide to rent the mall booth for 3 days for a total of $240 in rent. You spend an additional $150 on raw materials and use $25 of the raw materials to create celebrity pictures. These are what are called finished goods, like I had mentioned previously. You sell 125 caricatures, but no celebrity pictures. Here you have your total sales of $625. Your beginning inventory, remember we sold out last time, so we had none. Your total cost for paper and markers. And this ending inventory represents the celebrity pictures you did not sell. So we're going to subtract that out. 125 minus 625, leaving a gross profit of $500 minus the cost in rent, which was $240 for 3 days. Move that expense over here and come to your final net profit, which is also going to be equal to your earnings week to date. And go here again, we can look at how to transfer that over to the balance sheet by taking the previous cash minus the inventory minus rent plus sales. And that's how you get $585 here for cash. Then you have your finished goods, which were the celebrity pictures that you did not sell. You want to leave them in there. And then you find your earnings week to date of $260 by taking your total sales minus cost of goods sold minus expenses. And you can see here over in retained earnings that I moved up my previous earnings week ending to retained earnings. I decided to reinvest them back into the business. If you add all of these up, you'll come to $610. Well, as you're leaving the mall and after you've finished your balance sheet, a friend comes by and offers to buy all of your celebrity pictures for $50 on credit. When somebody buys something from you on credit, it is called an accounts receivable, meaning money that you expect to receive. The mall operator then walks up to you and says that he wants 1/2 up front or $120. Well, since you are not going to immediately start renting the mall at that point in time, this is what is called a prepaid expense. And you would also put this over here under your inventory. So you would put your prepaid expense of $120 here and subtract it from cash. You would put your accounts receivable here of $50, and then you would add the additional $50 over here to earnings week ending. You add all these up, comes to $635. So what happens if that debt your friend said he would pay to you, he doesn't pay to you? Real simple. Delete the amount that's in accounts receivable, then come down to earnings week ending and subtract that $50 from here as well. But do not touch retained earnings. If you had already moved this $235 up into retained earnings, this would have an amount of negative $50. So let's review. Cash is cash, real simple. Inventory is made up of raw materials and finished goods and prepaid expenses. Accounts receivable are payments made in credit. Prepaid expenses are payments made in advance of receiving benefits. Cost of inventory and prepaid expenses are subtracted from cash whenever they are purchased. And let's review liabilities. Accounts payable are short-term loans due in a month's time roughly, and they normally don't require interest payments. However, the loan that you received from your uncle was a notes payable because it's a long-term loan that does indeed require interest payments. And let's review equity. The original investment is the owner's investment in the company. Retained earnings are earnings that have been reinvested into the company. Earnings week to date is found by subtracting cost of goods sold and expenses from sales. And you can find that information over on your income statement. And bad debt is subtracted from earnings.
Investment analysis. Investment analysis may include analyzing new business opportunities that will maximize the company's profitability, selecting equity securities to generate passive income streams, or securing debt financing for business funding. Management accounting. Management accounting is an internal business function used to allocate business costs to goods or services produced by a company. Cost volume profit analysis. Cost volume profit (CVP) analysis is a technique that examines changes in profits in response to changes in sales volumes, costs, and prices. Profit equation and contribution margin. CVP analysis begins with the basic profit equation. Profit is equal to total revenue is equal to total costs. Separating costs into variable and fixed categories, we express profit as profit is equal to total revenue minus total variable costs minus total fixed costs. The contribution margin is total revenue minus total variable costs. The contribution margin per unit is the selling price per unit minus the variable cost per unit. Advantages and disadvantages of cost volume profit analysis. Decision making. CVP analysis provides managers with the advantage of being able to answer specific pragmatic questions needed in business analysis. Detail. Another major benefit of CVP analysis is that it provides a detailed snapshot of company activity. Limitations. The CVP approach to analysis is beneficial, but it is limited in the amount of information it can provide in a multi-product operation. Approximations. Even though CVP analysis is based on specific data and requires tremendous attention to detail, the best that it can do is provide approximate answers to questions rather than ones that are exact. Break-even analysis. Break-even analysis is a technique widely used by production management and management accountants. It is based on categorizing production costs between those which are variable and those that are fixed. Break-even analysis is used to determine when business will be able to cover all its expenses and begin to make a profit. To determine break-even point, use the equation. Break-even point is equal to fixed costs, unit selling price minus variable costs.
We're going to be discussing how to do a break-even analysis. Profit. It is every business owner's goal. After all, you go into business to make money, right? But how do you determine at which point your company, your product, or your service will in fact be profitable? By conducting a break-even analysis. Now, what exactly is breaking even? Breaking even is when your costs and your revenue are equivalent. Profit is when your revenue exceeds your costs. So, how do we get you on a path to profitability? I'm glad you asked because I've got some answers for you. First, we need to determine what your costs are. And there's two different classifications of costs. There are your fixed costs, those things that don't change on a monthly basis. Examples are rent and insurance. And there are variable costs, things that do in fact change on a monthly basis, such as contract labor, gas expenditures, marketing design, business cards, vendor services, or even client gifts. Now that we've identified what types of costs are commonly associated with your business, you need to come up with a price. And I know that makes you smile, right? So, how do you in fact determine pricing for your product or service? There are two ways to approaching this. The first is cost-based pricing. Take the cost it actually took to manufacture or create the item and adjust accordingly from there. And the second is price-based costing. What is the market willing to pay for that product or service? An example of this would be a haircut or consulting rate, looking at what the competitors are charging and then adjusting your prices accordingly. Now we're trying to calculate your break-even point, and we do that with a formula. We divide fixed costs from the unit selling price minus your variable costs. This gives you the amount of units you need to sell in order to break even. Naturally, if you surpass sales of those units, you're making profit, right? Of course. So you can see why this information is really important. And we've gone ahead and done this formula manually, but I will let you know that there are online calculators that will also create this formula for you as well. As a matter of fact, Inc.com has a great tool. You can also check the many references that will be found on the entrepreneur section of the About.com website. All in all, now that you're no longer breaking even and on your way to profitability, I hope you're really happy.
The break-even chart. In its simplest form, the break-even chart is a graphical representation of costs at various levels of activity shown on the same chart as the variation of income or sales revenue with the same variation in activity. The point at which neither profit nor loss is made is known as the break-even point. Fixed costs. Fixed costs are those business costs that are not directly related to the level of production or output. Examples of fixed costs are rent and rates, depreciation, research and development, marketing costs, non-revenue related, administration costs. Variable costs. Variable costs are those costs which vary directly with the level of output. Semi-variable costs. Whilst the distinction between fixed and variable costs is a convenient way of categorizing business costs, in reality, there are some costs which are fixed in nature but which increase when output reaches certain levels. Marginal costing. Marginal costing is a technique of ascertaining cost used in any method of costing. According to this technique, variable costs are charged to cost units and the fixed cost attributable to the relevant period is written off in full against the contribution for that period. Features of marginal costing. It is a method of recording costs and reporting profits. It involves ascertaining marginal costs, which is a difference of fixed cost and variable cost. The operating costs are differentiated into fixed costs and variable costs. Fixed costs are treated as period charge and are written off to the profit and loss account in the period incurred. Marginal contribution decides the profitability of the products. Margin of safety. In break-even analysis, margin of safety is the extent by which actual or projected sales exceed the break-even sales. It may be calculated simply as the difference between actual or projected sales and the break-even sales. Thus, MOS is equal to budgeted sales minus break-even sales, or budgeted sales minus break-even sales MOS budgeted sales. Exploring the concept of leverage in finance. Leverage is the process by which a business person, entrepreneur or investor is able to greatly increase the return on an investment through the use of borrowed money. Financial leverage. In the financial world, leverage is the amount of risk a person is willing to take. The greater the risk, the greater the potential payoff.
That's used to help you accomplish a goal. So, for example, if I want to dig a hole, I use a crane, which is a lever, to help me dig the hole. It uses my energy more effectively. It's the same thing in finance. Sometimes I don't have cash on hand, so I use leverage, which is the borrowing of money to finance an investment decision. So, that's really all there is to it. Leverage is just borrowing money in order to invest. Now, there's one thing that you need to understand about leverage, and that is that it amplifies the effect of an investment outcome. And what I mean by this is when you use leverage, good results are really, really good, and bad results are really, really bad. Let's illustrate this using the example of real estate. So, in 2006, I purchased a $100,000 house, but I don't have the $100,000 on hand. I only have a $10,000 initial investment, and I get the remaining $90,000 from the bank. So I have used leverage in this situation, $90,000 worth of leverage. Now let's move on to 2007. 2007 was a great year for real estate. So my house jumps up to $105,000. Now, you might be thinking, okay, that's pretty good, $5,000 return. But it's actually even better than you think because it's a $5,000 return on a $10,000 initial investment. That's actually a 50% return in just 1 year. And anyone in finance will tell you that 50% is a really, really good return. But hang on a sec. Let's now move on to 2008, which was certainly not a good year for real estate. In 2008, my house value falls to $90,000. So now you're thinking, okay, I've lost $15,000 from 2007 on a $100,000 house. That's not great, obviously, but it's not that bad. It's actually a lot worse than you think. And here's why. You now have a $90,000 house, but you also owe $90,000 to the bank because remember, you borrowed $90,000 to the bank to finance this investment decision. So your net equity is actually zero. Your $10,000 investment, you've lost the whole thing. And this is why leverage can cause great swings in value. In a good year, you can get a really, really high return, and in a bad year, you can lose everything. So that's why leverage is important to understand, and this is how you can apply that knowledge in the context of purchasing a new house or purchasing a new condominium.
Options. An option is the right to purchase a piece of property, stock, real estate, etc. at an agreed upon price during an agreed upon time frame. Options can be used to either speculate, in which the speculator expects the price to rise, or to hedge, insure against a rise in price. Selling stock short. A short sale involves a speculator contacting his broker and selling the stock owned by another investor. Financial leverage lights on an elusive concept. Financial leverage is at the heart of the current financial crisis, and now is as good a time as any to shed light on this elusive topic. Many people think it is effective to control risk by limiting leverage, but that is a trap to be avoided. We speak of leverage when an institution's financial assets are larger than its capital. An institution is exposed to the change in value of a position more than the amount that it paid for the position, or an institution owns a position with embedded leverage. Leverage can have impact on two aspects of the investment position. Exposure. Due to the extra investment, extra exposure is created to a market, region, investment style, or factor. Risk. As a result of the extra investment, returns and also risks, or better, volatility, are magnified. L is equal to 1 plus A whole upon 1, where A is the ratio of money borrowed to the ratio of money owned. Replication is not constant for derivatives. Options can be replicated by buying or selling the underlying and holding a position in cash. This insight is in fact fundamental to the pricing of options. The ratio of underlying stock to hold can be calculated from the option pricing formula and is referred to as the delta of the option. Leverage and risk. Under some limiting condition, the relation between leverage and risk is simple. If we assume a portfolio is levered by borrowing a truly risk-free asset, then using leverage only magnifies and shifts the distribution of returns. The distribution of returns shifts to the right if the return on the portfolio is larger than the return of the risk-free asset. It shifts left otherwise. L is equal to Rp minus Rf whole upon Ra minus Rf, where Rp is the return on the portfolio, Rf the return on the risk-free asset, and Ra the return on the underlying asset. Leverage introduces new risks. The most important additional risk is that liquidity becomes much more of an issue. Leverage enhances funding liquidity and asset liquidity risk. Leverage on a portfolio is not constant through time. When the return on the risk-free asset becomes high in relation to that on the assets, but still less than that on the assets, leverage rises fast. Exploring operating leverage. Operating leverage measures a firm's fixed versus variable costs. The greater proportion of fixed costs, the greater the operating leverage. Like financial leverage, operating leverage magnifies results, making gains look better and losses look worse. Exploring combined leverage. Combined or total leverage is the total amount of risk facing a business firm. It is the total amount of leverage that we can use to magnify the returns from our business. Summary. Now in the end, let us summarize what we have learnt in this lecture. The finance department of a company generates a variety of financial information that is helpful in decision making. Financial statements usually include the income statement, balance sheet, and statement of cash flows. Cost volume profit (CVP) analysis is a technique that examines changes in profits in response to changes in sales volumes, costs, and prices. Break-even analysis is based on categorizing production costs between those which are variable and those that are fixed. In break-even analysis, margin of safety is the extent by which actual or projected sales exceed the break-even sales.